Great athletes aren't just born, they're made. And sometimes the right gear makes all the difference. This is Bravo Consultancy, and today we're diving into a brand that redefines sportswear Under Armour. From a simple idea to a global powerhouse, this company changed how athletes perform and compete. We will explore its firm profile, market position, and strategies in this internal analysis. To start, let us dig deeper to these four key areas: firm profile, environmental survey, analysis, and critique. Let us look at the journey of Under Armour. The company began in 1996 when Kevin Plank founded the company and introduced moisture-wicking compression shirts, revolutionizing performance apparel. By 1997 to 1998, the brand launched heat gear and cold gear, providing athletes with year-round performance wear, and relocated its headquarters to Baltimore for better market access. In 2003 to 2005, Under Armour made a breakthrough with its Protect This House campaign, an iconic marketing success that strengthened its brand identity. During this period, the company also went public, fueling its rapid expansion. From 2006 to 2018, Under Armour expanded beyond apparel and entered the footwear market, reaching $1 billion in revenue. The company also made strategic acquisitions, including MyFitnessPal, and launched UA HOVR, a game-changing footwear technology. In 2020, Under Armour strengthened its brand by partnering with Stephen Curry, blending performance and fashion to appeal to a broader audience. Today, Under Armour continues to drive innovation, bold marketing, strategic expansion, and digital engagement, ensuring its competitive edge in the sportswear industry. Now that we've explored Under Armour's history, let's take a look at what drives the brand forward: its mission and vision. Under Armour's mission is simple yet powerful, which resonates well with its target audience, reinforcing the brand's commitment to performance enhancement. Its vision, while this highlights innovation and customer-centric thinking, does not tell us its desires in the long run. Under Armour's core value stands for more than just sportswear. It champions family, equality, teamwork, and sustainability. The company is committed to loving athletes, celebrating wins, standing for equality, fighting on together, and acting sustainably. Behind every great brand is a strong leadership team. At the top, we have Kevin Plank, the visionary founder of Under Armour. Alongside him is a team of executives responsible for operations, marketing, finance, and innovation, ensuring the company's continued growth and global success. But what is really happening with Under Armour? Now that we have explored Under Armour's core values and leadership, let's look at how the company operates and stays competitive. To do this, we'll break down Under Armour's business model canvas, which outlines the key elements that drive its success and how it captures value in the sportswear industry. Under Armour stands out in the competitive sportswear market by focusing on athletic performance enhancement, ensuring durability and quality to withstand intense training, and maintaining a premium brand image that appeals to elite athletes and those striving for excellence. Under Armour collaborates with several key partners to strengthen its brand and distribution. This includes sports teams and athlete endorsements, suppliers and manufacturers, retail and online distribution partners. To maintain its position in the market, Under Armour focuses on key activities such as designing and manufacturing high-quality sportswear, marketing and brand promotion, research development and product innovation, and efficient sales and distribution. Their success is driven by critical resources, including human resources, financial resources, intellectual property, physical assets like warehouses, and brand and factory houses. Under Armour builds strong customer relationships through after-sales support, engaging marketing campaigns, a direct-to-customer approach, and a UA rewards program which fosters loyalty with exclusive perks and promotions. Under Armour targets professional athletes, fitness enthusiasts, and individuals who prioritize an active lifestyle. Their largest market is in North America, making up 61% of their customer base, while the rest comes from Europe, the Middle East, Africa, Asia Pacific, and Latin America. On the other hand, they also reach its customers through various channels including official website, country-specific websites, wholesalers, physical retail stores, and its dedicated e-commerce platform. Their main costs come from manufacturing, which takes up 53.87% of net revenue, followed by marketing and advertising at 10%, and research and development. Their revenue comes from direct sales, wholesale, and licensing. In 2024, apparel made up 66% of net revenue, footwear with 24%, accessories with 7%, and licensing with 2%. Now, let's examine the external factors that influence the sportswear industry through a PESTEL analysis. For political factors, Under Armour faces trade tensions between the US and China, impacting its supply chain. The 25% tariff on Chinese imports affects 35% of its manufacturing. Additionally, government efforts to combat climate change have led to stricter regulations, increasing production costs. Under economic factors, the global apparel market is growing, with the athletic footwear industry expected to reach $165 billion by 2030. However, rising interest rates and a 4.1% unemployment rate affect consumer spending, posing challenges for the industry. For social-cultural factors, during post-pandemic, 85% of consumers prioritize comfort and 56% prefer brands that align with their values. The demand for sustainable sportswear is increasing, pushing the sportswear industry to adapt to eco-conscious trends. Under technological factors, digital platforms like Amazon have boosted brand accessibility. The wearable technology market is expected to hit $265 billion by 2026, creating opportunities for innovation in smart fitness gear. Compliance with labor laws and intellectual property protections is essential for this industry to avoid legal risks and maintain brand integrity. Lastly, environmental factors include rise of global temperatures, concerns about environmental and social responsibility, and as well as changing weather patterns can affect production. Now that we have uncovered the situation of the sportswear industry, let us look at the analysis starting with the financials. For the horizontal analysis of Under Armour's treatment of operations, there has been a sharp decline in the cost of goods sold from 2020 to 2024. This is also evident in the year 3 and 2 cumulative annual growth rate of 9.89% to 4.30%. Moreover, there is also a sharp decline on the company's selling, general, and administrative expenses from 7.96% on 2021 to 2020 year-on-year to 0.85% 2024 year-on-year. This is also reflected on the 3-year and 2-year CAGR of 3.39% to 1.18%. The declining expenses seems like a great sign that would indicate an increase in cost efficiency, but let's take a look at the company's revenue and profit. For the net revenue, we can also see a similar declining trend. A promising 31.02% increase in net revenue from 2020 to 2021 did not continue by 2023 to 2024, with a 3.41% decrease. This can also be seen on the 3-year and 2-year CAGR of 8.41% to negative 1.38%. Moreover, the company's net income also shows a sharp decline. While they initially bounced back from a net loss in 2020 to a 163.9% increase in 2021, this did not continue and instead decreased to 38.03% in 2024. It is also worth noting that one of the main contributors of the net loss in 2020 was the $601,599 restructuring and impairment charges, which decreased to $40,518 in 2021. Under Armour underwent restructuring plan last 2020 to address the financial impacts of the COVID-19 pandemic. Let us now look at the vertical analysis of Under Armour's statement of operations. Net profit margin shows minimal fluctuations from 2021 to 2024. Cost of goods sold consistently accounts for approximately half of net revenue. Operating expenses remain stable from 2021 to 2024 at around 40% of net revenue. But if we look at 2020, operating expenses are at 61.98% and the company had a net loss of 12.27% due to the restructuring plan. For the vertical analysis of the balance sheet, we can see the increasing proportion of non-current assets relative to current assets from 2020 to 2024. We can also see here the ratio of liabilities and stockholders' equity that makes up the total assets, with total liabilities decreasing from 2020 to 2024. Under Armour's current ratio improved to 2.5 in 2024 from 2.2 in 2023. The quick ratio also increased to 1.6 from 1.3, showing that the company can meet obligations with liquid assets, excluding inventory. The cash ratio rose to 0.7, an increase from 0.5. While an improvement, a cash ratio below 1 indicates current cash reserves alone are insufficient to cover all immediate obligations. The gross profit margin shows some fluctuation, currently at 46.13% in 2024, an increase from 44.79% in 2023, but below earlier years. Operating and net profit margins stand at 4.03% and 4.07% respectively in 2024, decreasing from 2023 but a significant improvement from the negative figures in 2020. Return on assets is 4.87% and return on equity is 10.78% for 2024, both lower than previous periods but positive, indicating overall profitability. Under Armour significantly improved inventory turnover from 2020 to 2023, indicating better inventory management. However, a slight dip in 2024 can also be seen. The accounts receivable turnover has declined over the years, notably in 2024. This is mirrored by an increasing DSO, meaning it's taking the company longer to collect payments from customers. On a positive note, the asset turnover has remained relatively stable from 2021 to 2024, showing consistent efficiency in using the assets to generate sales. One thing to note is the increasing DSO of the company. The 2024 DSO of 48.52 is significantly higher compared to Nike's 2024 DSO of 30.41. This can indicate an efficiency in collecting payments from customers and might increase the likelihood of bad debts, decrease profitability, and reduce cash inflows. Under Armour has reduced its reliance on debt financing since 2020 and relied more on equity financing instead. As seen on its debt-to-equity ratios, it shows that it has financed a smaller portion of its assets with debt, indicating a stronger and more stable financial situation. With its significantly reduced debt, suggests Under Armour can meet its long-term obligations and there is reduced financial risk. Under Armour had a volatile cash flow performance from 2021 to 2024. In 2021, its operating cash flow covered only 50% of its current liabilities. In 2023, it consumed more cash than it generated in this operating period. And although it significantly improved in 2024, its operating cash flow was only able to cover 30% of its current liabilities, which is much lower than that of 2021. This fluctuating trend in operating cash flow from 2021 to 2024 indicates a high concern on their ability to meet its short-term obligations using cash generated from its business activities. Under Armour's earnings per share increased from 2021 to 2023, but this significantly decreased in 2024, suggesting a decline in profitability per share which could turn away investors. Its price-to-earning ratio also decreased in 2023, but it experienced a significant surge in 2024. This implies that investors were willing to pay a much higher premium for each dollar of Under Armour's earnings in 2024. However, its price-to-book ratio has consistently declined since 2021, and there's a significant dip in 2024 compared to 2021. This suggests a lower market valuation relative to the company's net assets over the years. Now let's see into Under Armour's performance from 2023 to 2024 relative to the performance of Lululemon in the same years. As we can see, Under Armour's return on equity greatly decreased and is significantly lower compared to that of Lululemon. This was mainly driven by its decline in UA's profit margin due to a decrease in its net income in 2024. Lululemon, on the other hand, significantly increased their profit margin. It also shows a slight inefficient utilization of its assets. The same is true for Lululemon. However, UA has relied less on debt financing given its lower financial leverage. This can be seen in the significant increase of its average equity in 2024, indicating that it relied more on equity financing instead. The same is true for Lululemon. However, even though they were on the same terms of having only slight inefficiencies with asset utilization and being less reliant on debt financing, UA's return on equity is primarily affected by its low profit margin because it generated lower net income in 2024. We can also see how Under Armour generated much lower net income compared to Lululemon relative to their generated revenue. In summary, Under Armour has underperformed compared to Lululemon, making it less attractive to investors. Now let's see Under Armour's value chain framework. Under Armour is led by founder Kevin Plank and a structured leadership team. This enables strong strategic planning and brand consistency. For human resource management, Under Armour hires top talent, partners with athletes, and trains staff to adopt to digital transformation. This ensures a skilled and aligned workforce. When it comes to their technology development, Under Armour heavily invests in R&D and 3D printing for faster prototyping, improved design, and product customization. For procurement, Under Armour sources globally and partners with contract manufacturers. This allows cost efficiency and scalable production. Now let's go to the primary activities. Under Armour imports raw materials, uses inventory systems, and works closely with select suppliers for control and efficiency. Under operations, production is outsourced mainly to Asia, like China and Vietnam, to minimize costs. Facilities use advanced manufacturing systems to ensure quality. Distribution is handled by third-party logistic providers. Under Armour's strong e-commerce platform also drives a large share of revenue. For marketing and sales, Under Armour runs iconic campaigns like Protect This House and partners with athletes. They engage customers via digital platforms and influencer content. Lastly, Under Armour uses customer feedback to refine products and offers strong customer service to resolve issues, boosting brand loyalty. For the VO framework, competitive parity across all categories. Whilst resources are valuable, they are not rare, costly to imitate, or well organized to capture value. While all these resources and capabilities can help exploit opportunities for Under Armour, these are not enough to surpass its competitors. What Under Armour does is already being done by existing competitors in the industry, especially with industry leaders such as Nike doing it better. Now for the overall critique. Under Armour's strengths lie in its diverse product portfolio, which helps reduce reliance on any single product category and minimizes risk from market fluctuations. The brand has a strong e-commerce presence, investing in digital initiatives to enhance customer accessibility and sales. It also benefits from multiple distribution channels with a mix of wholesale and direct-to-consumer sales. Additionally, customization options allow customers to personalize products, increasing engagement and satisfaction. Despite its strengths, Under Armour faces several challenges. Its heavy dependence on the athlete segment prevents them in catering to diverse segments. High operating costs pose financial strain with anticipated losses in the upcoming fiscal years. The company also struggles against well-established competitors, which was seen in the DuPont analysis. Furthermore, Under Armour lacks transparency in its sustainability efforts, with slow progress in reducing its environmental impact and communicating its sustainability strategies. So basically, this leaves Under Armour with so much room for improvement. That concludes the story on what really happened to Under Armour. And again, this is Bravo Consultancy.